Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today I'm going to be analyzing CVS Health stock. This one came in by request down in the comment section of one of the other videos, and if you have a request, feel free to drop it in the comment section. I will put it on the list behind me on that whiteboard, and eventually I will make a video analysis of it. If it's a stock that's in the S&P 500, I post those on YouTube for free. If it's not, I post those on Patreon and the full Cyclical Investors Club service, and those links will be down in the description. Let's see. As always, this is not financial advice. This is just how I analyze stocks. I'm going to show you exactly what I think about and what I'm looking at, and usually I'll tell you why I wouldn't buy it or the price that I would potentially buy a stock if it ever gets to that level. So with that, let's get into CVS. I've never covered or written on CVS that I can remember ever. So, and part of the reason is, they really, you could see how stagnant they were. Well, the main reason was they had a big merger purchase, we'll call it M&A, with Aetna, the health insurer, if I recall correctly, around here. And I just went and glanced at it. It looked like it closed in 2018. So one thing you'll notice is that the stock has been trading at these very low PE ratios. So we're down here in the single digits to 10. Maybe it's averaged like a 10 PE or 9 PE over this time period. Just glancing at it without digging in like deep and knowing that they had the M&A, and they're always doing kind of other M&A too, but that was like a big one, I think. Is they probably took on some debt in order to do that. So if you go down and look, the total enterprise value is significantly larger. It's about 75, I think 73 when I just looked at it, percent more than the market cap. Some of that, I think CVS does. I know they have stores. I'm not sure how all that's structured. It's possible some of this is like rent obligations and things like that. But generally speaking, these additional obligations that you would have to pay for if you just bought the whole business, along with the market cap of the business, is about 75% more. So if you think about it, if you add 75% to these PE ratios, then you're looking at like a 17 here, right? Instead of averaging 10, it averages like 17, 18, which is normal. So without doing like a bunch of like deep research and trying to pencil all that out, when I just glance at this, like that is how I would just, in my mind, I'd say, okay, that probably makes sense. That's probably what's going on. And since I analyze a lot of stocks, I'm not crunching the individual numbers. I'm just looking at what's probably the simplest explanation. So if you weren't looking at that and you just looked at, let's see where they at, an 8 PE basically right now. So they look super cheap, especially when you look back and you look at their historical earnings trend, which is pretty much straight up in a straight line. I'm sure the basic is, yeah, we see the purchase right here of or the merger, whatever you want to call it, of Aetna. That's what this big spike down is. I think they just had another one. I saw Elizabeth Warren was on kind of griping about something, so they probably just had another one here, and that's what shows up. But other than that M&A, the earnings growth has been absolutely fine. Earnings growth per share. So this looks pretty good. And I would say, like, at the time that they started with the big M&A, earnings growth hadn't like stalled out yet, and so it's not like they were really kind of grasping for growth. I think maybe they saw that it was kind of slowing down, maybe coming, or just trying to expand or do whatever. I'm not gonna second guess their reasoning. They probably had a reason, but the main thing is it doesn't look like it was like a total act of desperation. The stock price was pretty expensive here relative to the past. So maybe that was part of the deal. I'm not sure. But we can't explain why it's so cheap pretty much just by looking at that. Now, 8 is really cheap. So, you're still looking at, we'll go through the numbers here in a second. But we still have some earnings growth. Now, the one thing I would say is recently earnings growth is slower, right? Especially these last few years, it's pretty slow. We do have COVID involved in all this, and I'm sure that has taken its toll. 2018 was a tax cut year, so that was kind of an outlier. So we have, let's call it definitely like single digit growth, maybe mid single digit. Again, I'll show you what I have for that in a minute. Fastgraphs is saying 7% since 2015, but those bigger years came farther back, and next year's expected to be basically flat. So honestly, when you glance at like a flat earnings growth, if the market thought that was going to just carry on forever, then an 8 PE is the appropriate PE. So, I mean, it's probably not as cheap based on exactly what earnings are doing right now as it might appear. It would look to be about right. Some of that depends on their ability to pass on inflation. If they can pass on inflation better, but there's kind of a delay, so it might take a year or two for them to increase prices, then this might be a little too pessimistic. That 8 PE should maybe be like a 10 PE, if that's the case. And it might be. But that's just kind of my initial take at the very beginning here. So cyclicality looks good. I picked the time frame from 2015. That's kind of my standard one lately, as long as I control for recession, which I'm going to later. Let's see. So yeah, let's just get into the valuation given these things. I would say that the key things that we need to keep in mind are the debt and other obligations, and probably a recession, because this didn't really count as much of a recession. Earnings didn't even fall. So we want to think of, okay, even if the valuation looks good, can it get a lot better even during a recession? So I'd say those are the two things to kind of key in on here. All right. Let's see here. So CVS. So I have a 6.5% earnings growth rate. That's a little more conservative than the fast graph. And I have current PE of, let's see, about 8. So that's about the same as fast graph. So, but I will take into account that difference between the total enterprise value and the market cap. So it's trading at a $68 stock price, and it will, let's see, when we include the debt, that would go up to a theoretical price of 118. And so that is what I will base this earnings yield on. So that increases this. I'm not sure exactly what PE that translates to, but it translates to like a 7% earnings yield instead of a much higher, I guess, at 8, if it was at 8 PE. So we take that 7% earnings yield. And the way I think about this is, if I bought the whole business for $100, I would earn $7 on that a year. And that would grow at that 6.5% rate per each year, and for 10 years. And at the end, I would get about $200 on my $100 investment. Let's see here. So that translates into a CAGR, if you put that into a CAGR calculator, of 7.4%. My threshold to buy a stock, and this includes the kind of the debt and everything, my threshold is about 8%. So it's not quite a buy, but it's pretty close. It looks like if it fell 10%, just using my basic thresholds that I would normally use without considering recessions, it's pretty close to a buy. It just needs to fall like 10% more to a little under $62 per share. So it looks okay there. But if we have a recession, then I'm looking a little bit lower, and this is actually what I'm using right now, about 25% lower, assuming, and I'll look at the peak earnings. I think they're kind of locked in now. So that $50 area is probably what I'd be looking at until recession risk is kind of gone. Let's look at, so that is based on peak earnings at $8.69. If they really surprise this last quarter, they could push that slightly higher, in which case I would raise that recession PE because it's based on peak earnings and trough price. But let me double check. I think I only based this on 2020. I don't think, yeah, 2020. So I didn't go back to 2008 because I think 2008 was incredibly cheap, or it might have been less. Yeah, okay. So the reason I didn't use 2008 recession in this case is because probably because of this M&A, they had more debt and the market was just kind of treating them worse in the more recent recession. So that's what I was looking for there. I usually pick the more conservative one or the more recent one. In this case, the more recent one was the more conservative one. So that's what I went with. So if we took the peak earnings of $7.08, the trough price of, let me see, 51.72 it looks like, or 52. They're about the same. Trough price of 52 back here, that would give me the recession PE that I would want to work with. And let's see what it was. It was about 7.31. And so that's kind of the most pessimistic kind of calculation that you can do. And I usually want to get within, if it's below a 10 and it's in single digits, if I can get within like 40% of that, then I think that usually is a pretty decent deal. And you can probably get good returns afterwards, all other things equal. So when I add 40% to that, I get a PE of 10.23. So I don't have because of the debt, I don't have that other PE displayed, which is what I was looking for. But it's like the current PE with the debt and stuff included. Judging by how far the stock still needs to fall, it'd be about 25% or 30% higher than here. So it's probably trading at that like a debt adjusted 13 PE right now. And that's why 12.5 to 13. And that's why it would need to fall about 25% more in order for me to buy it potentially. So revenue looks okay. I don't know if this includes any recent M&A. But it does include kind of COVID and everything. But this looks okay. Now the very recent earnings growth is really slow, and maybe that could be a concern. I mean, if we move this, for example, starting in 2017, then just using the fast graphs, we're down to like a 5% growth rate, and then if we take out that 2018 tax year, we're looking at a 4%. Now, below 4% is kind of my threshold where that's too slow of growth. So this is definitely like on the borderline potentially of being too slow. But I mean, usually if you can buy a stock, even if it's kind of slowly going nowhere, cheap enough, then usually even if things don't work out after a couple years, you don't usually lose like a bunch of money. So I think if you bought this 25% lower, then where are we at? How would I say, like $50? So if you bought this at like $50 a share, which would be right near the lows back here, even if the economy kind of stumbled and maybe things didn't work out great for them, you're probably gonna be okay and not really lose a bunch of money. So that's the good part about investments like this sometimes. And then if something goes right unexpectedly, you can stand to make quite a lot of money. If we just looked at the 2020 lows, for example, and then we brought it up to like the market peak, that was a 100% gain. So, and really there's not a whole lot different. I mean, we had the pandemic and everything, but that's kind of the same thing. Maybe something good happens for them, and if you buy them cheap enough, you can get, and maybe it happens 2 years from now, and then it takes another 2 years for it to rise. So in 4 years, you get a double. Like that's pretty good. So that's the potential upside. So if you buy these cheap enough, even though it's kind of on the edge of like my growth, and you can always sell them if it becomes clear. Like if earnings decline for a couple years, there's not really explanation for that. Revenues come down too much. you can always sell the stock later then, and usually you don't lose too much. So I do like how, as long as you buy it cheap enough, you get a little bit of asymmetric risk reward kind of in your favor. But we don't know, and nobody, I don't think anybody really knows how exactly how all that's going to go. You just try to get the odds in your favor. All right, so that's my thoughts on CVS. I do track that one, and I may end up buying it if it gets down near that $50 level, and I'll let everybody know if I do. If you like this, click the subscribe button. If you have any requests, drop them in the comment section. I'll see everybody later.